Hello, Steph and Remy here. Welcome to our channel. Remy's off taking a walk, so she kind of thought today's topic was a little bit boring, but please stay tuned because it is an important topic if you're thinking about buying a home. We're going to go over credit scores and what it all means. Stay tuned. So your credit score is more than just a number. It actually tells lenders and other businesses that might be lending you money what sort of a risk you pose. The higher the number, the better risk you are, meaning you're more apt to pay your bills. It can actually affect your insurance rates, the interest rate that you could get on a mortgage, and even your job prospects. So there are 4 different credit reporting agencies out there, FICO being the most popular. The range of credit scores goes from a low of 300 to a high of about 900. Some of the different agencies have a little bit different rating criteria. But interestingly enough, the average US credit score is 695. And in 2015, the average score was 755 when qualifying for a mortgage. So a lot of people that fell into some financial trouble, they'll wonder how long will it take to get back into a good credit standing. And the answer is generally 7 years, whether you had a bankruptcy or had a bunch of late payments, had a short sale on a house, foreclosure. 7 years later, it'll be wiped out and you can start with a clean slate. So a lot of people have asked me what credit score will get them lower interest rates, and the answer to that is about 760 and above. So there really shouldn't be a mystery as to what your credit score is. There are a bunch of websites out there that will give you a free credit report. A couple of them are creditkarma.com and freecreditreport.com. So go ahead and check those out if you're starting to think about getting into buying a home and getting a loan. A lot of people also ask, what would it take for me just to qualify for a loan? And the answer is about 680 to about 720, with 760 being the benchmark for the decrease in interest rate. So a lot of people ask, how is my credit score calculated? And there are 30 different components that weigh in, but the top 5 that you'd want to know about are 35% is your payment history. You absolutely want to pay everything on time and try to even pay off your bills if you can. 30% is the amount owed. So if you tend to carry high balances on your credit cards, that is not good. That will tend to bring your credit score down. The next is length of credit history. We had kids in college and we co-signed for them, so to get their credit established. We didn't pay their bills for them, but they've had credit established for about 5 or 6 years, and it really does help boost that credit score. So get those credit cards going early on. So 10% of your credit score is new credit established, and that has a negative impact on your score. What they think is happening is that you might be opening up one credit card to pay off another, and you just keep popping along, and it's better to just have a few stable ones that you're paying off every month. And the last 10% is the types of credit in use. You don't want to be opening up a bunch of rinky-dink credit cards that aren't well established and known in the industry. That does not reflect well on your credit score either. I hope this has helped demystify the questions about credit scores, and I hope that you're on your way to improving your credit score or possibly getting ready to apply for a mortgage and buy a home. Thanks as always for watching. Look who just came in from her walk. Didn't want to miss a photo op.